folks. I see you jumping in. Really good to see you all, especially the familiar faces. This is awesome. Welcome. If you want to go ahead and open up Zoom chat, I'm going to post a Nearpod link, and
Jackie.
we're going to use that to post questions. Um, and I'll do another introduction and explain, but Dan's going to go ahead and do a presentation, and then we're going to leave a lot of time at the end for questions. And you may think of questions as he's speaking, and so we're going to set up this board where you can ask them. So I just posted it there. If you're joining us from a desktop or a laptop, you just need to click that URL. If you are using a mobile device, you're going to need the app for Nearpod. I think a lot of you are well versed in Nearpod. And there's already our first comment. Dan, I didn't recognize you without the hair.
I had to get my ears lowered. It was getting so gross. It was doing that weird like curl up thing. I just
Well,
can't.
see, Dan,
Like this?
people are seeing you for the first time, and you should be like, Tara, what are you talking about?
I
I'm
know,
always
right? This is what
clean
it looks like
shaven.
all
Yeah.
the time. Yeah.
All right. Welcome, folks. If you are just joining us, we'll start in a couple minutes. Please open up Zoom chat, and I'm posting a link to a board, a Nearpod board collaboration board we have set up where you can post questions um, while Dan is speaking, and then we will get to as many of those questions as we can after Dan runs through his presentation. And I think we'll start probably in about a minute here. Great to see so many people jumping in. It's almost like I feel like it's almost tax season.
It's probably an understatement.
Could be.
I have a good friend who's an accountant, and like I don't know how you guys survive this time of year. I mean, August
Set.
is nice, but now it seems crazy.
Well, yeah, it's 7 days a week with lots of Red Bull.
That's the secret, huh? Okay. That was gonna be one of my questions I
Well,
was gonna post.
actually, or a CBD beverage is also a
All right,
staple of
Scott,
it.
I'm muting our guest.
Wait, that's legal.
Hey, where we are, that's totally legal. There's no THC in this.
Well, there's two different CBDs too. There's ones that come from the cannabis plant, and then there was one that come from the hemp plant.
We'll talk about creative accounting.
Hey, there's actually now a whole industry for that. It's crazy.
All right. Well, welcome everyone. I'm gonna post the Nearpod information one more time, Scott. If you can catch up people as they join us. But if you have just joined us in the past minute or two and haven't heard this message, please open up your Zoom chat. I am posting a link to Nearpod. It looks like we already have 15 people are on. That's great. You may post questions there as Dan's doing his presentation, but let's get started. Welcome, everyone. As I said before, it is so great to see so many familiar faces. We love when you join us in these events. I am Dan Otter. I am a former elementary school teacher. I'm the executive director of 403bwise.org. We are a nonprofit dedicated to helping fix the broken K-12 403b. I got involved in this because when I was a teacher, sales agents were trying to sell me and my colleagues high-cost annuity products. So I started 403b Wise way back in 2000 with the mission of educating teachers and school employees and helping them advocate for better, lower cost investment choices. I have met so many amazing people since the launch of that website, and I'm going to introduce one of them right now, my podcast partner, and we have written books together, and we do lots of presentations together, Scott Downhauer.
Hey, thanks, Dan. Good. It's probably evening for everybody. Probably nobody from Texas here either. That's terrible what's going on down there. Two of my brothers live down there, and they don't have power. So thank you all for joining us. I'll be quick. My name is Scott Downhauer. I am a certified financial planner. I have a master's degree in financial planning. I've also taught at a couple different universities, financial planning and finance. But today I'm here to listen, not to speak, which is kind of nice. I'm also not taking on new clients just because I know everybody here. That's like the question on their mind at this point. Seeing the guy in the orange shirt. Anyways, so without further ado, our guest today is Dan Herron, and gosh, it had to be sometime last year. He reached out to Dan and I, saw what we were doing, really liked it. I think we jumped on a Zoom call with him. I don't even remember. And we were like, yeah, hey, yeah, we definitely need more advisors working, in the school employee space that are fiduciaries and are looking to put the best interest of their clients first, who are looking to always do what's right for their clients. And Dan was all in on that. He started joining our Zoom events sometime last year and attended a lot of them. So much so that whenever I got a question that stumped me or I wasn't 100% sure of myself, I started asking Dan if he'd unmute and help answer the question for me, because he's in some cases more qualified than I am, especially when it comes to taxes. Dan is not only a certified financial planner, he is also a certified public accountant who holds the PFS designation, which is kind of like the CFP of CPAs. And now you all know how I feel when I listen to all of the acronyms that teachers and school employees use. So PFS stands for, oh my gosh, I'm losing. I'm going to have Dan tell you what PFS stands for. But he started joining us, started answering questions. And one day after we were done with an event, Dan Otter, executive director of 403 Wise, said, "Hey, Dan, why don't you join us for an event and actually just do one on taxes? Would you like to do that?" And Dan was kind enough to say yes. So without I want to let Dan tell you a little bit about himself. So without further ado, I'm going to introduce Mr. Dan Herron.
Thanks, Scott. I appreciate it. Welcome, everyone. I realize that this is a very interesting and convoluted topic for a lot of you, but at the same time, we're going to get we had some pretty good questions from the audience all over the last couple months. So last couple weeks. And so we're going to address those. But at the same time, we're going to kind of run through some deductions and tax credits that teachers are eligible to take. So I'm going to start off the presentation now. Let's see. 1 minute, sorry. Here we go. Cool. And then, cool. So hopefully everybody can see that. If nobody can, just let me know. But what we're gonna do is firsthand, I'm gonna give you a disclaimer because this is apparently what I need to do. So this is basically for informational purposes only and should not be interpreted as financial or tax advice. Before using anything that's actually shown in this presentation, we recommend that you contact your accountant or financial advisor to make sure that anything discussed here makes sense for your financial situation. So a little bit about me, and Scott touched on this briefly, is, here's a little bit of my credentials. So I have a bachelor's of science degree of economics with an emphasis in finance from the Cal Poly San Luis Obispo. I have a master's degree from St. Mary's College of California with an emphasis in investment management, portfolio management. I am a certified public accountant. I'm also a personal financial specialist, PFS, Scott, for you, and then a certified financial planner as well. And on top of that, this probably should look pretty familiar. There are a lot of us that actually will sign this when we talk to our clients or potential clients. And so I realize it's a little bit outdated because I signed it about a week ago, but I just wanted to show that there are some of us who aren't afraid of actually signing this. And so I realize that when you look at a 1040, it's pretty convoluted, right? It's like you have 20 million schedules, you have all these boxes, it says see instructions, da 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 da. This is the equation for your tax return. So I realize it's a lot, but if you can take it in steps and in chunks, that's probably be the best way to go, especially if you're preparing your own return. So first off, you have to report all your total income, meaning your W-2 wages, your pension distributions, anything along those lines, your dividends, your interest, your capital gains, all of that goodness. You minus your exclusions. Think of exclusions as tax exempt income, right? Basically, there's tax exempt income which isn't taxable at the federal level. So even though you do report it on your tax return, it's excluded from from gross income, which total income minus exclusions equals gross income. The next step is gross income minus 4 AGI deductions. 4 AGI deductions are the front page, or used to be on the front page of the 1040. Those are like your student loan interest deductions, your traditional IRA deductions. Used to be alimony, but that's no longer there. Your HSA contributions that you do. And so that's what you're looking for as a 4 AGI deduction. Once you determine your adjusted gross income, then you subtract either your itemized deductions, your charitable donations, your property taxes, all those kind of things, assuming that you itemize, or you take the standard deduction, which depending on your filing status will determine how much you can actually deduct. The additional information or the other deduction that you get to take is what's known as the qualified business income deduction. These are for individuals who are either a sole proprietorship, an S corporation, or a partnership. Think of it as your corporation files a return, it then flows through to your individual. That amount of information that flows through to your individual determines how much of the QBI deduction that you get. This is a relatively new thing. This started with the Tax Cuts and Jobs Act back in 2018. Once you deduct your QBI deduction, you get taxable income. This is where you really kind of get into the numbers in terms of determining your tax liability. You take your taxable income, multiply by your tax rates, which we are going to get into a second. So hold on for just a minute. Plus your other taxes. So if you have a sole proprietorship, think self-employed taxes is what we get added, minus your tax credits, minus your federal withholding, minus your estimated payments, equals your balance due or your refund owed. So that, in a nutshell, is your 1040 for federal purposes. A lot of people get confused on what marginal tax rates are. So we're going to kind of go over this a little bit here to kind of show you how it works. When you think of marginal tax rates, think of it as buckets that you're filling, right? As your income continues to grow, you fill certain buckets which are taxed at a particular rate. So, for example, the example on the right, if you had taxable income of $50,000, the first amount between 0 to 9,875, assuming that you're single. Sorry, I forgot to disclose that. The amount of money that fills up the bucket between 0 to $9,875 gets taxed at 10%. The next dollar over that $9,000 threshold starts to get taxed at a 12% bracket. Once you reach the $40,000 limit, the next dollar over gets taxed at 22%. So if you think about it, right, you are literally filling buckets as you go up the marginal tax bracket. And so that's how your overall tax gets calculated. A lot of people go, oh, I'm in the 24% tax bracket, so therefore $50,000 times 24,000 or 24% is blank. Well, that's not necessarily the case. And so in essence, assuming that your income is relatively lower, you are actually paying lower tax rates on that income. So that's something that we typically see people get confused on. And so I'm hoping that elaboration kind of makes sense. So tax breaks for teachers. As we all know, a lot of your tax breaks are going to come from the educational realm. There's the educator expense deduction, which I'm assuming the majority of you are familiar with. It's a $250 for AGI deduction, or $500 if both are teachers in your married filing joint. The requirements, for this particular deduction is you have to work as a teacher, an instructor, a counselor, principal, or aide for students in kindergarten through 12th grade. If you are a college instructor or another post-secondary education or school, you are no longer eligible for that. Oops. The second requirement that you need to meet is you need to work 900 hours at a school that is certified by the state, which I'm assuming, based on how many hours I hear you guys work, a lot, I'm assuming that's not very hard to meet. Your eligible expenses that can be attributed to the 4 AGI deduction of $250 or $500 are books, school supplies, computer equipment. So think like the headset that Dan's wearing, or a webcam like all of us are maybe using, athletic equipment for PE teachers, and other items that are helpful in the classroom. That's pretty vague, but a good rule of thumb is that as long as it's not excessive, like think about it like buying a brand new MacBook Pro. That wouldn't be an eligible expense, but maybe a new mouse or something along those lines would be qualified as an eligible expense. For 2020, and I haven't seen it yet actually extended to 2021, you are eligible to deduct some of your personal protective equipment or PPE in that amount. So if you bought hand sanitizer for your classroom, you can utilize that amount for that deduction. Any of your excess expenditures, which I'm assuming is a lot, can be deducted as an unreimbursed employee expense, which is an itemized deduction subject to the 2% AGI limitation. That's basically, if you ever look at a Schedule A, it's the very bottom section where that would come in. However, Tax Cuts and Jobs Act had to figure out how to pay for the tax cuts, so they took those away. But here's the good news. If you have a state that doesn't conform to federal law, there is a chance that you could deduct those additional expenditures, assuming that you're itemizing your deductions. So be aware of that. So if you decide that maybe this year is the year that you want to go have a tax preparer prepare your information, bring all the information regardless of what you've heard or read about, because there is a chance that even though it's not deductible for federal purposes, you could still deduct that information on your state return. There's another a way that you could probably sidestep that. However, this is kind of a gray area, is if you donated school supplies to your school, you can get a charitable donation for that, assuming that you're itemized. That doesn't count for the $300 for AGI deduction that's new for 2020. So if you spent $300 on a charitable donation, you get a deduction, a 4 AGI deduction for 2020 and 2021. Non-cash donations don't count towards that amount. So just be aware of that. If you were reimbursed for your expenses, you can't deduct that amount. You cannot double dip. You cannot get paid and take a deduction for it. That's a big no-no with the IRS. Also, if you had a distribution from an educational account like a 529 plan that you utilize that money to pay for those expenses, you cannot take the deduction. Something that we already talked about earlier was the charitable donations. If you itemize your deductions, you could donate cash to school. That's another way that you could actually, hopefully they would take that money and use it for school supplies that you need. I just touched on this briefly, for 2020, if you don't itemize, you can get a $300 4 AGI deduction for cash donations to a 501c3. Donor advised funds or private foundations don't count. So that's probably like a good one. A good example would be if you did a $300 donation to St. Jude, that would count as a 4 AGI deduction. For 2021, this deduction increases if you're filing a joint return. This increases to $600. For 2020, it's only $300. So regardless if you're single or if you're married, you're only getting a $300 deduction for this time around. Also, one thing that people don't really consider when you do a charitable donation, if you receive property or services in exchange for your donation, you have to deduct the value of those services or property that you get. So for example, if you buy a raffle ticket for $100 and you get a dinner in turn for 50, you have to back out the 50. So you only have a $50 donation at that point. So if you're into the raffle ordeal, or you go to, I don't know, a lot of dinners where there's raffles or that kind of stuff, just be aware of that so that, you know, you don't write off something that you're getting more value of as opposed to what you should be getting. Lifetime learning credit. So We all know that education is huge for teachers. You know, there's a lot of times, or I think most of the time, you guys are required to have at least a master's degree to have some of your teaching credentials. Um, this is the lifetime learning credit, or this is the tax credit for you. So if you have $10,000 of eligible education expenses, you're eligible for a maximum of 20% of that, which is $2,000. This is a non-refundable credit, so it will reduce your tax liability, but you won't get a refund because of it. The eligible expenses for your $2,000 tax credit are tuition, fees, books, and supplies needed for coursework. So that means that if you're in graduate school and you have to go buy books on Amazon for that class you're taking, those are eligible expenses. The ineligible ones: room and board, insurance, medical expenses, transportation, and living expenses. So even though maybe you get some scholarships for your living expenses or anything like that, unfortunately, those aren't deductible for this particular credit. This can be claimed at the undergrad, graduate, or vocational school level. It can also be used for coursework to develop a new skill or improve a job skill. Think of it more of like, what is this credit doing for me? Am I spending money to make myself better for the workforce? And am I potentially also getting a credential out of it? That's even more acknowledgement that you should be looking into this credit. If you used a 529 distribution or another type of educational account to pay for these expenses, you cannot double dip. So you have to back out that distribution from the 529 plan out of your eligible expenses. There's also another caveat. You cannot use this with other educational tax credits like the American Opportunity Tax Credit or the tuition fees and education deduction, which is a 4 AGI deduction for the same student in the same year. So if you work with a preparer or you do it yourself, usually your tax software and or your preparer will use the optimization feature to determine which tax credit is the most advantageous for you, assuming that you qualify. There are income limitations to it. So if you are single, MAGI is modified adjusted gross income. For simplification purposes, we're just going to assume AGI. If you are below $59,000 as a single filer, there's a good chance you're going to get this full credit, assuming that you spent, at least $10,000 of expenses. Once you hit the $59,000 to $69,000 range, the tax credit starts phasing out. Once you get past the $69,000 range, it's completely eliminated. The same kind of process applies to married filing joint individuals. And also, if you're married filing separately, you can't claim it at all. One form that you really need to have to take this credit is the Form 1098-T. This reports the tuition that was paid to any eligible institutions. If you don't get one, go to your educational institution and ask them to give you one. It's not that hard to get. But the IRS said it is a requirement for you to have this to be able to take this credit. So if you haven't got one in the mail the last couple of weeks, I would call your institution and see if you can get one. Student loan interest. So this is probably one that you're all familiar with, so I'll go through this pretty quickly. This is a 4 AGI deduction for your student loan interest that you pay on qualified loans. The maximum amount is up to $2,500 that you get in terms of the interest that you paid. There are limitations to it and there are phase outs. So for example, if you are single and your modified adjusted gross income, or AGI, is below 70,000, you have a pretty good shot at getting the maximum deduction of $2,500. If you're between the 70 to 85 realm, it's going to start phasing out. And then once you get above 85, it's completely gone. There are requirements for this particular loan, which is actually kind of interesting. You use the loan for qualified educational expenses, think tuition. You took the loan out for your own education, which means, basically I went to a lender, they gave me a loan, I'm paying the school directly by myself, so therefore I get the deduction. Parents, if you take a loan out to pay for your kids' schooling, you can get a deduction, assuming that your adjusted gross income is low enough, for the interest paid on that loan. So if you took out a plus loan to help your kids go to school, you can deduct that interest. So keep that in mind when you're preparing your taxes this year. The form that you should get to report the amount of interest that you can deduct or that was paid to determine the deduction is the form 1098E. Even if you didn't get the form, you can ask the lender to provide you some information of year-to-date interest that you paid to determine your deduction. Another aspect that I'm hoping eventually, gets considered is your employer assistance. So if your school district or your employer has the ability to pay money to help you get schooling, it can pay up to $5,250 of your expenses that is excluded from taxable income. So in theory, you're getting a benefit from that $5,000 that you don't have to pay tax on. This also can include student loans, so your employer can help you pay off those loans. So just be aware of that. One thing that a lot of people, and this depends on where you are located in the nation, is there are state tax credits applicable to teachers, depending on what state you're in. So if you want to just, it's easily Googleable, right? It's teacher tax credits, Maryland, or New Hampshire, or wherever you're located. And you will be surprised that there are some credits available out there. So when you're doing your return, make sure you do a little bit of research to figure out if we can maximize that tax credit for you. So this is what Tara sent me. This is for the self-employed, the private tutors, the side hustlers, and the speech language pathologists. If you are a 1099 income individual taxpayer, that means that you are not getting a W-2. That means that literally somebody is cutting you a check and you are responsible for any taxes that are applicable to it. More than likely, unless you have a corporation or another entity, you are a Schedule C, which is a sole proprietorship. That is a simple schedule that is reported on your individual tax return that you just fill out while you're going through the whole steps of filling out your return. You can deduct expenses against your 1099 income to be deductible. And this is a couple questions that I had from Tara. The expense must be ordinary and necessary in your business or your trade. What that means is, for example, if you need a computer to help you do the work of your tutoring or as a speech language pathologist, that is a deductible expense because a couple different reasons. When you buy fixed assets for a company, you can write it off in the first year thanks to what's called bonus depreciation or 179 depreciation. I know that's going down a rabbit hole, but there is eligibility to write it off in the first year. An example of a non-fixed asset would be something along the lines of supplies. Like, let's say you need a legal pad to take notes while you're doing something with a pupil or something along those lines. That would be deemed ordinary and necessary. An example of something that wouldn't be ordinary is, hey, I'm a SLP, I'm going to go buy a Ferrari because I think it's, going to make me look better or whatever. That would not be ordinary and necessary as a deductible expense. There are other advantages to being a sole proprietorship, assuming that that's what you are. If you pay your own health insurance, you are eligible to deduct the full amount of premiums as a 4 AGI deduction. You also can save more for retirement, and Scott touched on this a couple weeks ago. There is a lot of flexibility in, if you have a high net income, you can put more money away for retirement because of it. It roughly equates to 20% of your net. There's a little bit of a calculation to it, but if you have a high net income on your tax return, there's a good chance that you could be maximizing another retirement vehicle to help you put more away for retirement. Be careful with this though. If you have other retirement plans, the employee contribution aspect of those plans are aggregated. So for example, if you have a solo 401k where there is both the employee and employer contribution, and you also have a 403b, the employee contributions of the 403b and the solo 401k will be aggregated together. So you could only put away 19,500. It's not 19,500 each. So just be aware of that if you have both things going on. There's also the home office. Assuming that you have a room in your house that is 100% business use, you can write off eligible expenses attributed to that. meaning if you have a mortgage, if you have property taxes, if you have repairs and maintenance or homeowners insurance, you can take a portion of those, and that's determined by the total square footage of your office versus your house. You can take a portion of those against your Schedule C net income, which can be a pretty good deduction considering, you're writing off against something that's subject to SE tax. You're getting more of a deduction, so you have to pay less SE tax on your return. Mileage. If you have a home office and you drive to temporary work locations, you can write off that mileage. So just be aware of that. Also, if you don't have a home office, but you have a office at a school, if you're driving to temporary locations, the mileage between the school and going to those other job locations is deductible. So definitely keep track of that if you're driving around a lot. The deduction for half of self-employed tax. So when you are a Schedule C, you are now responsible for the employee and employer portions of your payroll taxes. Those are usually paid through estimated tax payments, which we'll get into a second. But you do get a 4 AGI deduction for 1/2 of that total self-employment tax that you pay. I touched on this briefly. If you purchase a new equipment, like a laptop, you can get accelerated depreciation in the first year. So if you buy a $1,500 MacBook Pro, which I would imagine is probably shorting it a little bit, you can write that off in the first year. So just be aware of that if you're preparing your return. If you have a lot of moving pieces with your Schedule C, it may be advantageous for you to contact a tax preparer because they know the ins and outs of these kind of things and will be proactive with you, during tax time and also throughout the year. With a Schedule C, it's not necessarily expensive to prepare it as opposed to a corporate tax return. So you have that going for you. It is also eligible for the QBI deduction, which is an additional deduction taken against your taxable income. So just be aware of that. The disadvantages. SE income, you are now the employee and the employer. So you are on the hook for both sides of the tax. Usually when you're a W-2 employee, you are only paying your portion. Guess what? You're paying the other portion as well. So you have to be aware of that. Usually, if you have a tax liability that is higher than $1,000, estimated quarterly tax payments will kick in. Those can be calculated on the return and also on projections. So if you're going into that realm where you're going to start having estimated tax payments, it would probably behoove you to actually engage a preparer to help you with this, because this is something we can help you with. Also, liability insurance is clutch. A Schedule C is no different than your individual, meaning if somebody sues your Schedule C, they can come after your personal assets. So one way to hedge against that is to have really good liability insurance. It is extremely important that you take that into consideration. 2020. So there's been a lot of changes since 2019, obviously with COVID and the relief efforts, right? These are the kind of things that I've been preparing returns now for the last couple of weeks. And these are the kind of things that we are catching people not necessarily thinking about. Did you receive a stimulus check? It should have shown up in a couple different ways. It could have shown up as a direct deposit, assuming that your IRS has your bank account information on file. They also had the bright idea of sending out debit cards, which I've heard a lot of people have thrown away. So that's kind of MIA. But if you got a stimulus check in 2020 and recently in 2021, you have to report that on your 2020 return. The stimulus checks aren't taxable, but what happens is there's a reconciliation process that happens on your 2020 return. So if you've never received a stimulus check, what they give you is a refundable tax credit. However, if you did receive the checks, it reduces that refundable tax credit on your actual return. So word of advice, if you got the stimulus checks, report it. You don't want to double dip. You don't want to get the tax credit and you say that you didn't get the stimulus check because the IRS, that'll be a giant red flag. Did you take a COVID-related distribution out from your retirement accounts in 2020? There's the eligibility of either including it in this year's income, or 2020 tax year income, or ratably over the next 3 years. There's a little bit of nuance with that. So if you have a financial planner or somebody that can help you walk you through that, that's something that's a little bit confusing. It really just depends on when you got the distribution, if you recontributed the money back, the filing season, or the filing deadlines, et cetera. So Just know that if you took that distribution, it was penalty free. However, it is still ordinary taxable income to you, assuming that it's a pre-tax vehicle. Did you receive unemployment compensation, which I would imagine that some of you may have? For federal purposes, guess what? That's taxable. So you have to report that income on your return. You'll likely be getting or have gotten already what's called a 1099-G. That reports the amount of unemployment compensation you received in 2020. So just be on the lookout for that. One nice thing that they did for those who have kids or those who earn substantially lower income that are eligible for the earned income tax credit, they are allowing you to look at the differences between your 2019 and 2020 income. So the software should walk you through this if you're using TurboTax. I have never used TurboTax, so that's something I'm uncertain about, but maybe somebody can clarify that for me. But they will let you look at what your 2019 income is versus your 2020. If 2019 is more advantageous, they will let you use that for these tax credits. So just be aware of that when you're preparing a return. We touched on this briefly already, so I'll probably skip this one, but just remember, if you donated $300 in cash to a 501c3 and you are not itemizing, you could get a $300 for AGI deduction. Here are the rumors that have actually accelerated a lot of people wanting to get their filing done. And this is something that we're kind of waiting on Biden to tell us what's going to happen. They are talking about excluding a portion of your unemployment compensation that you received. And so that's kind of been a giant gray area, and we haven't gotten a lot of detail on that, but there is a chance that a portion of the money that you receive from unemployment could be not taxable. I don't know when they're going to figure that out. And so you have to really kind of figure out what's more advantageous for you, because the flip side of it is there's potentially a third stimulus check in July coming out. So if your 2020 income is lower than 2019, it may be advantageous to file early your 2020 return to become eligible for that stimulus check. I realize that this isn't very concrete, and unfortunately, this is what we're dealing with. As a preparer, I don't get a whole lot more information than you do. So we're still waiting on this to kind of determine, but the chances of the unemployment being untaxable, I would say, has a lesser chance of actually going through versus a third stimulus check. So you can take that for it as you will. So I got some questions from the audience, and these were sent to me by Dan and Tara. And so I'm going to kind of address these as much as I can. And I also want to open it up for conversation later after this. So I'm just going to push through these. An uncle of mine left my kid $10,000 to use for college. Do I have to pay tax on it? This is Scott's favorite answer. It depends. It depends how it was left to the child or how it was left to you. If it was just straight up cash, it's not taxable to you. However, if for some reason it's held in a trust and you got a distribution from a trust, there is a chance that a portion of that distribution can become taxable. And so if there's a trust out there that you know that you're going to be getting some sort of benefit from, talk to the executor of the trust, or the trustee, and see if there's a K1 that's going to be kicking out, because what could happen is you could file, then you get a K1, and then you have to amend to report it. So just be careful of that. I just started a teachers pay teachers store. I had no idea what this was beforehand, so forgive me. How do I declare this income? From what I gathered, and you guys can totally correct me on the back end of this, but if there is a profit motive for this particular business, and depending on how much volume you are doing, you may have to report this on a Schedule C and be subject to SC tax. However, if you are just like, hey, I threw some stuff on there, I'm just selling it, I'm not active in this business, it's just kind of doing its own thing, you would report it as other income. And the cool thing is you can deduct expenses up to that gross amount that you received. And so you still get some tax benefit from there. One thing I want you to be cognizant of when you have a sole proprietorship are hobby loss rules. A lot of people like to say, especially those who, I don't know, they knit a sweatshirt and all of a sudden they sell it and they're not really trying to do anything of it, but they have huge expenses for all the yarn that they're buying. The IRS has a rule against that. Hobby losses basically say that if in any of the 3 out of the last 5 years, if you had continual losses and you were utilizing a Schedule C, they will deem it as a hobby, which can significantly reduce the ability for you to deduct expenses against that income. So really take that in consideration. I do have sources on the back end of this presentation. I'm also going to make this available for you guys to have as copies. I'm going to give it to Dan so he can post it as a Google Doc. But just be aware of what is my motive. Am I trying to actually produce a profit? If I am, most likely it could be a Schedule C. If you're just throwing stuff on there, not really thinking about it, good chances ordinary other income where you could deduct all of your expenses up to that amount, but you can't go over, you can't produce a loss. This one is very interesting. So this is kind of this is relatively new, and I haven't heard you had to expressly say that you had to have a high deductible health insurance plan for HSA, but I'll just read the question. My district awards me $4,800 for choosing a high deductible health plan, which easily covers my HSA contributions of $3,550. When TurboTax asked if I had a high deductible plan, and I said yes, it gave me $1,000 more in my return. Is this correct or I did something wrong? Well, it depends. It depends what awards mean, right? And how you are actually getting that money. What the question is ultimately trying to get at is it probably sees that you have HSA contributions. So it's trying to make sure that you have a high deductible health plan because that is required for an HSA. So if you clicked a box, chances are it's just going to be deducting the full amount that you contributed. However, there are weird moving pieces to this, which we're going to get into. If your employer pays your benefit directly, pays your insurance premiums, cool, you're in the clear. If you have some sort of health reimbursement arrangement in HRA, be careful because it can only be used in tandem if you're enrolled in a high deductible health plan. The HRA pays the premiums only, meaning it's not paying for any of the qualified medical expenses, and there's no double dipping. You cannot pay the same expense with an HRA and an HSA, so be careful with that. Also, there may be a chance that if you are running your HSA contributions through payroll, that you don't want to double dip. What I mean by that is when you report your HSA contributions through your W-2 wages, it's already reducing box 1, box 3, and box 5 on your W-2. You can't take a deduction for it at the same time either. So if you think about it, box 1 is being reduced. That means that your reportable income is also being reduced. So it's taking that benefit into account already. So make sure that you don't double dip on this because that could cause an issue. I don't know necessarily if you would get audited for it, but if they saw a big discrepancy where you got a huge refund, that could create a red flag where they'd send a letter out. Okay, so this one I appreciate, but it could also be done in a whole different webinar. So, Dan, Scott, if we want to do that, we can totally do this. But I got a question about what happens to withdrawals in retirement? What are the strategies that are attributed to it? It really depends. It depends what type of vehicles you have, right? Do you have a traditional IRA? Do you have a 453 or a 457? Do you have a 403B? Do you have a simple IRA, an HSA? Do you have after tax? Do you have a Roth or IRA? Do you have a Roth 403B? So or a taxable account or Social Security if you're lucky enough, right? It really depends on what you have at your disposal. Before we jump into the actual strategies attributed to it, I want you guys to understand that there are penalties attributed to early withdrawals. And so I list them out here, and I'm not going to go through every one of them. But one of them that Scott highlighted a couple of weeks ago is the exception for the 457 plan. However, I want to reiterate something very interesting that he said was if you take another retirement vehicle and roll it over into that 457B plan, that portion of that rollover will be taxable and will have the 10% penalty attributed to it. So before you start rolling over, and this goes for all of your retirement accounts, be aware of what you're losing or what you're gaining before you do that rollover. The penalty itself, the 10% early withdrawal penalty, doesn't apply to actual 457B contributions, but it does apply to the rollover that you did, assuming it's not another 457B plan. if you have a simple IRA, which I'm imagining most of you don't, the 2 years that it's open, there's a 25% penalty, to just be aware of that. If you're reimbursing, if you're taking distributions out of an HSA for non-qualified medical expenses before the age of 65, there's a 20% penalty on top of that. So just be aware that before you take a withdrawal, Google it or reach out to your financial advisor, your tax preparer, or a combination of both to walk through the pros and cons of what you're about to walk into.